What are the S&P 500 and Nasdaq? Have you ever heard someone on the news say, the S&P 500 was up today, or the Nasdaq had a big gain? If you're new to investing, those names can sound confusing. Are they stocks? Companies? Investment accounts? In this video, I'm going to explain exactly what the S&P 500 and the Nasdaq are, why investors pay attention to them, and how they can help you build wealth over time. Let's start with a simple question. Imagine you're a teacher trying to figure out how an entire classroom performed on a test. Instead of looking at every student's score individually, you might calculate the class average. That average gives you a quick snapshot of how the class performed overall. The stock market works in a similar way. There are thousands of publicly traded companies in the United States. Tracking each company individually would be almost impossible. That's why market indexes were created. A market index is simply a group of companies used to measure the performance of a section of the stock market. Think of it as a report card for the market. Now let's talk about the S&P 500. The S&P 500 is one of the most popular stock market indexes in the world. It tracks approximately 500 of the largest publicly traded companies in the United States. These companies come from many different industries, including technology, healthcare, banking, consumer goods, and energy. When most people say the stock market is up, they're often referring to the S&P 500. The reason investors like the S&P 500 is because it provides a broad picture of the American economy. When many large companies are doing well, the index tends to rise. When many companies struggle, the index tends to fall. Now let's look at the Nasdaq. The Nasdaq is both a stock exchange and a collection of market indexes. When investors talk about the Nasdaq, they are usually referring to the Nasdaq Composite Index or the Nasdaq 100. Unlike the S&P 500, the Nasdaq contains a much larger number of companies and has a stronger focus on technology. Many of the world's biggest technology companies are heavily represented in the Nasdaq. Because of this, the Nasdaq often experiences larger gains during strong technology booms. However, it can also experience larger declines when technology stocks struggle. So what's the difference between the S&P 500 and the Nasdaq? The S&P 500 is more diversified. It includes companies from many sectors of the economy. The Nasdaq tends to be more concentrated in technology and innovation-focused businesses. Think of the S&P 500 as a balanced sports team with players from every position. Think of the Nasdaq as a team filled with star offensive players who can score a lot of points, but may also be more volatile. Let's use a simple example. Imagine two investors each invest $1,000. One chooses a fund that tracks the S&P 500. The other chooses a fund that tracks the Nasdaq. If technology companies have an incredible year, the Nasdaq investor may see higher returns. But if technology stocks experience a downturn, the Nasdaq investor may also experience larger losses. Meanwhile, the S&P 500 investor may experience a smoother ride because the investment is spread across more sectors. Neither index is automatically better. They simply have different characteristics. Many investors choose the S&P 500 because of its broad diversification. Others prefer the Nasdaq because they believe technology and innovation will continue driving future growth. Some investors even own both. Now here's the important part. You don't need thousands of dollars to invest in hundreds of companies. Many investment funds and ETFs are designed to track these indexes. By purchasing a single index fund or ETF, investors can gain exposure to many companies at once. This is one reason index investing has become so popular. It allows beginners to participate in the growth of major companies without having to pick individual winners. So let's recap. The S&P 500 tracks around 500 of America's largest companies and provides a broad view of the U.S. stock market. The Nasdaq focuses more heavily on technology and growth-oriented companies. Both are market indexes used by investors to measure performance and build investment portfolios. Understanding these two indexes is one of the first steps toward becoming a smarter investor. If you found this explanation helpful, be sure to subscribe for more beginner-friendly finance videos. And remember, successful investing isn't about predicting the future. It's about understanding the basics, staying consistent, and giving your investments time to grow. Thanks for watching, and I'll see you in the next video.